Most of them are traded on the New York Stock Exchange. And some of the companies, the Essex Property Trust, Avalon Bay, Logis, Simon, Kilroy, Wawa. So there's a bunch of them. Kilroy's down in San Francisco, Simon's in Chicago, Logis is in San Francisco, Avalon Bay is in San Jose, Washington, D.C., Essex Property Trust is in Palo Alto. Okay. Just gives you kind of an idea. And you can look these up. All right? As we know, there are 4 valuation methods. You might want to break out your calculators. If you want to borrow a calculator, I have a bunch of them. Oh, here. Anybody need a calculator? Calculator. There are 4 valuation methods. In this case study, we are going to use funds from operations per share, FFO per share for the REIT stock valuation. The following are the case study assumptions. Perpetuity model, we can use that for the initial and the terminal values. Gordon growth, we can use those for the initial and the terminal values. The multiple approach. Oh, and they actually do give you multiples, FFO multiples, which are analogous to PE multiples or price earnings multiples, stock prices divided by earnings per share, and the discounted cash flow. We also show the calculations for the valuations using the above methods. So then there's your inputs. What is the intrinsic value of the stock? Show the intrinsic valuation, weighted average calculations. If you were asked with 3 weighted scenarios, what would they be? Why did you choose those weights? What are your arguments for the weights? What is the premium of the final intrinsic value above the current stock price? Is it within a reasonable or probable range? What are your trade recommendations for the stock? And how many trades can you recommend to your clients or your trading division? All right. So what's the first valuation method? Got it. Okay. And what's the equation? What's the theoretical equation? You have it in your notes.
It's the net operating income divided.
We're not going to use that, but let's just use the theoretical one first.
Oh, a dividend or?
No. Cash flow T plus 1 divided by the discount rate. That's going to give us the value of that. Okay, so what cash flow are we going to use for this? What cash flow are we using? What cash flow are we using? I'm just going to, this drives my students crazy. What cash flow are we using? What cash flow? It's all right here. Now, what cash flow are we using? What's the cash flow? I already said it. And it's on the paper. What is it? What cash flow are we using? And the last one we used net operating income. What are we using for this one? It's on the page. Read the page.
Funds from operations.
Funds from operations. Are we using per share? Yep. So we're using FFO per share. So do we use last year, this year's, or next year's FFO per share? Next year's, exactly. So how do we calculate next year's FFO per share? How do we get next year's?
We add 2% to
No, we're not going to use that one. Do we use the going in or the terminal growth rate, or do we use the pro forma growth rates? this year's cash flow? Yeah, what's this year's FFO per share? $15. So how do I get next year's?
Multiply by 1.08.
Got it. Does everybody get that? Is anybody totally confused? Okay, so I'm going to take the $15, which is this year's FFO per share, and I'm going to multiply it by 1.08, which was given to you. So what's next year's FFO per share? What is it?
1620.
1620. Got it. Does everybody get that? I got one person who told me that. I got 30 people in the class. Are you guys have the calculators out? Checking it? Is it 1620?
Yes.
Got it. Okay. What do I do with that? How do I get the valuation? What? Yeah, by what? What is it? Yeah, the expected return of 8%. Okay, and that's going to give us what? 202.50. Is that correct?
Yes.
Okay, got it. What's the next method?
Annuity.
What is it?
Order growth.
Gordon growth. Got it. Or the constant growth. What do we need to calculate the valuation using the Gordon growth? What do we need?
We need the cash flow.
We need the cash flow. This year, last year, or next year's?
Next year.
Next year's, what's next year's cash flow?
1620.
1620. Got it. And then what do we do with the 1620?
Divide it by the growth rate minus, the expected return.
The expected return?
Minus the growth rate.
Got it. I minus G. What's the expected return?
8%.
Right away. And what's the growth rate? What's the growing in?
Using 60.
Going in.
Next year's growth rate.
Going in. What's the going in?
8%.
2%. It gives me 0.06. Got it. What's 1620 divided by 0.06? What is it? 270. Got it. That's going to give me the valuation for Gordon growth. Okay, what's the next method? Multiple approach. Excellent. Thank you. And what's the equation? Well, let's just go. Let's do the equation. I like to do the equation so you can see it. So what's the equation? Ron, what's the equation for the multiple approach? What's the equation? You did it on the exam. Yeah, I just want to see if you know the theory. Now let's do the theory.
Cash flow.
So we're going to do the cash flow this year, next year's, and last year's. 2 plus 1 multiplied by what? M plus 1 equals V. So what's next year's cash flow? 20. Do they give you any multiples? Do they give you any FFO multiples?
Yeah.
Stock price divided by FFO per share. Okay. Do they give us any multiples?
Yeah.
Yeah. What do they give us?
T times 2 is 6.
You know, the multiples.
15 times.
Yeah. What's the multiples? Read off the multiples.
15, 22, and 25.
Got it. And I'd like to do 25 first. 22. And what's the other one? 15. So what's 1620, 20 times 25? What is it? 405. And what's 1620 times 22? Can you just yell at me? Just yell at me.
356.
356, thank you. I'm used to being yelled at, obviously. And then what's 1620 times 15?
243.
243. Got it. Thank you. And which one would you use? I have 3. Well, that's pretty high. Multiples aren't at 25 anymore. They were at 25 2 years ago. Yeah, they probably should be like this. 360. Probably this one. This is too high. It's not close. And so I would probably pick some mid. So 243, 270, 202. Are these pretty close to each other? Are these pretty close to each other? Yeah, they're in kind of, so we know we're getting for obviously. What's the next method? Yeah, DCF. What's the first thing that I need to know? Before I start, I need something first. If I'm going to set up the structure, the discounted cash flow methodology, what's really the first thing I need to know to set up the structure? Well, not the variables yet, I just need the structure. What's the first thing? Yeah, exactly, the holding period. So how many years? What's the holding period?
6.
How many? No, the holding period. What's the holding period?
5.
5 years.
Was it 3, 5,
3, 4. I made a mistake. It should be 5. So make that correction. 5-year holding. And how many cash flows do you need with the DCF? If I got a 5-year holding period, I need 6. And what do we use the 6-year cash flow for? Got it. Excellent. Now we can calculate cash flows first, or what I like to do is to calculate the discount factors. So what do you want to do, the cash flows or the discount factors? I like to do the discount factors. So do you want to do the cash flows or the discount factors? Discount factors. So what I like to do is set this up. What's our discount rate? What are we using to discount the cash flows? 8%. Awesome. 1.081, 1.082, 1.083, 1.084, 1.08. Actually, I'm going to be year 6. So what's 1.08 to the 1? 1.08. What's 1.08 squared? Calculators, please. Huh? Yeah. 1.17. What's 1.08 to the third? 1.36. Is that right?
3 rounded.
1.26. 1.26? Is that right? I like to see like 8 heads go.
Yeah.
Yes.
And then what's 1.08 to the fourth? 1.36, and what's 1.08 to the fifth? 1.47, is that right? Okay, got it. Excellent. So what do we use for the first year cash flow? We're using FFO per share. 1620. Okay. And how do we get year two? Yeah, by what? How much? What?
6%.
Okay, and then what's the equation? Some people don't have the finance, so they need to, you gotta explain it. Yeah, 1.06, great. What's 1620 times 1.06? 1717, is that correct?
Yes.
Okay, is everybody getting that? You guys writing it down? A lot of you are, okay, I see you're using the calculator. Where's your calculator? Yeah, it's right here. Calculator. These calculations. Thank you. Okay, so how do we get the third year cash flow? 1 point what? What is it?
Oh, is it 204?
1.04. I have I'm a little hard of hearing. I surfed for like 20 years out at Ocean Beach, and my ears started clogging up. And hard for me to hear. Plus my cat's barking at me all the time. All right, so how do we get, so 1717 times 1.04? What is it? 1786, got it. And then how do I get year 4? 1.02, so that's 1786 times 1.02. 1822, got it. And then how do I get year 5? 1.01. What's 1822 times 1.01?
1839.
1840?
1840.
1840? And do we just discount these back and get the present value? Is that it? Is that what we do? What do we need to do? Yeah, we need to grow it out. And what are we growing out by? 1%? 1.01? So what's 1840 times 1.01? What is it? 18.58, got it. Okay, theoretical question. These real estate, these real estate, do their cash flows remain flat forever or grow at a constant rate? They probably grow at a constant rate. Don't they write long-term leases? A lot of these industrial and office leases. When you sign a lease, it's like for 5 or 10 years. There's a CPI adjustment embedded in the lease contract. So over time, every year, the rental rates are adjusted up by the CPI. So do the cash flows grow at a constant rate over time? So are we going to use perpetuity or the word grow? Well, use the word grow, exactly. Does it give you a discount rate to use to calculate the terminal value? Do they give you a discount rate or an expected return to use? What is it?
13%.
Where's that?
Expected rate of return terminal equals 13%.
We have 10%.
Oh, I'm looking at the wrong page.
Yeah. So 10. And then what about the growth rate? What are you going to use?
9%. minus 1%.
Minus 0.01. The reg is what? 0.09. Okay, test question. Why would we use a higher discount rate for the terminal value calculation than the going in discount rate? Why am I using a higher discount rate or a higher expected return? What would be the logic?
Because at the end of year 6,
No, come on. Why would I have a higher discount rate? Require a higher rate of return to calculate the terminal value. Is risk and return correlated to each other? Does the other one be compensated for additional risk?
Yes.
Right? And get a higher rate of return? Can I forecast with 100% certainty what the cash flows are going to be in the future from year 6 to year 30?
No.
Is that risky? Yes. What about real estate? Is real estate bombarded by weather events, acid rain, and climate change and all that stuff? So the weather and everything, does that deteriorate the property, cause the physical deterioration?
Yes.
Yeah, is that risky? Yeah. And what about the, in 30 years from now? Is that going to be the state-of-the-art building?
No.
Are there going to be more state-of-the-art technologies?
Yes.
So there'll be not only physical deterioration, but functional obsolescence, the physical layout, the steel structures, the glass, all of those things. The building's going to be more efficient, aren't they, in 30 years from now than they are today. So there's functional obsolescence, which is also a risk. So we have to increase the terminal discount rate. We got to adjust it up to take into consideration the risk over the next, from year 6 through year 30. And why would I lower the growth rate from 2% to 1%? Is what? Why would I lower the growth rate?
Because growth, it doesn't grow like that forever. Like it can't continue to grow higher.
Yeah, it can't continue to grow higher. But do buildings compete against newer buildings? So as new buildings come online, are they going to steal my tenants? Because that building's state-of-the-art, my building's, physically deteriorated and functionally obsolescent. So I won't be able to grow the rents and get higher rents in the future. Actually, my real rents will probably come down in the future. So I'm going to lower the growth rate. So what's 1858 divided by 0.09?
206.48.
206.48, is that right?
Yep.
Okay, and then what do I do with the terminal value?
Add it to year 5.
Yeah, that's the year's worth of cash flow. Got it. Nice. So what's 206.48 plus 1840? What's 206.48 plus 1840? 224.88. Is that right?
Yeah.
Okay. Then what do I do with 224.88? What do I do with the 224.88?
Add it to the year 4. Put it down at the bottom. Subtract.
Say it again. Yep. Yeah. Divide this by 1.47. So what's 224.88 divided by 1.47? 152.98. Is that right? Is that right? Okay. Now what do I do? Now what? Divide this, divide the 1822 by the 1.36. What do we get? Gotta get it right. 13.40?
Yeah.
Yeah, you have to do the calculators to try to get the answers answered as soon as possible, okay? 'Cause you might be in a room with some smarty pants, Stanford or Berkeley people, that's what they do. They just crunch these numbers, blur them out as fast as they can. Okay? Then they confirm the numbers, or they'll check it to see what you may be competing against them. So what do we do next?
Same thing.
What is it? Can you speak up? Okay, so the 1786 divided by the 1.26.
14.72.
14.47.
Now everybody's nice.
Yeah, everybody's got it.
Next one's 14.68.
So we divide this. Is it?
There's a correction. There's a correction. 14.17. Yep, 178.
He said yours.
No, the 14.47 should be 1.
Yeah, should be one, so 14.47?
No, on year 3, should be 17, not 47.
Okay.
And then
Is this right?
on year one? No,
That's 15. That's 15.
All right.
No, just 15.
That's 15.
Yeah.
Like that.
Mhm.
Now what do we do?
Add them all up.
Add them up, what do you get?
It's 210 and 23 cents.
2, 10, and 23.
Sure.
Got it. Are all those pretty close to each other?
Yeah.
Yeah, they're pretty close. That's a good sign when you see that kind of convergence. So now we got to come up with the intrinsic value. All right. So what were the 4 intrinsic valuation methodologies again? What were the 4 methodologies again? What is it?
Perpetuity.
Perpetuity. It's the next
Barney
one.
Grove, multiple approach, discounted cash flow.
And DC. Got it. And what was the intrinsic value for the perpetuity?
202.50,
And what was it for Gordon Grove?
270,
And what was it for multiple?
243,
And what was it for DCF?
210.23.
Now what we have to do is we got to come up with the scenarios. The weighting scheme. We had to come up with 3 weighting schemes. So which methodology is more theoretically correct for evaluating
Discount cash flows.
discounted cash flow? So what would you come up with if you were going to come up with a weighting scheme to calculate the weighted average, to come up with the intrinsic value under a scenario, one scenario, and we'll do 3 of them. And you said the most important valuation method was the discounted cash flow. What weight would you give the DCF?
Under what scenario though?
Yeah.
Just for the scenario.
Yeah, but he said it was the most important, so that one should get the biggest weight.
50?
Okay. Okay. What about the other ones? What would be the second most important valuation method? Which one would be the second most important? What?
I'm not sure.
Well, we already said that you can do inductive or deductive reasoning, inductive or deductive. So if you know that the perpetuity model is the most simplistic and that you know that the cash flows are going to grow at a constant rate forever,
Multiple,
then you know that either Gordon growth or the multiple is one of the two.
or multiple,
Okay, and what weight would you give the multiple?
20%,
20? Okay. And what would you give Gordon growth and perpetuity?
15.
For,
Oh, for each one.
will you tell me?
20 for Gordon growth.
What, here, 10? Yeah,
This is all hypothetical, right?
it's theoretical too. I mean, you're telling me the Gordon growth and multiple are actually equally important in this first scenario. Okay. Then after we're done, you may disagree after we have some discussions. Okay. Give me another scenario. Now that you've gone through the first one, maybe you can fine tune the second scenario to be more realistic. So which one is the most important?
discounted cash flow.
Which is the second most important? Multiple. What's the third?
Gordon growth,
And what's the last?
perpetuity.
Got it. Give me another scenario.
40% discount cash flow.
40%? Okay.
I didn't sound too happy. I think it's like
No,
70%.
I mean, you know, the multiple is really important too. So what do you want to give for the multiple?
30. Oh, 30.
How much?
30.
What about Gordon growth?
20.
Give me one more. What?
60% discount cash flow.
Okay.
25%.
For which one?
Multiple.
25?
Yeah.
Okay. How much for the Gordon growth? 10. And how much for PCI?
5.
We know that this is what, 20.25? That's pretty easy. What's 270 times 0.2?
54.
0, 0. What's 243 times 0.2?
4860.
How much?
4860.
And 0.5, that's what, 105? Something like that, 105.
Well,
So add those up. And what do you get? $227.97. Got it. Okay, let's do the same thing with these.
So that's 2025.
Okay, so we know that this is 2025. This one is 5400.
7290.
This is, no. The 243 times 0.3.
Which equals 7290.
Okay. Got it. And what's 21023 times 0.4?
8409.
84.
Yeah, 09.
And what does that sum up to be? What is it? What? 24, got it. And let's do this one too. And what is 202.50 times 0.05?
10,
What is it?
13, 10, 13,
Is that correct?
10, 13.
1013. Got it. And we know that this is what, 2700? And then what is 243 times 20?
60.75.
What is it?
60.75.
Got it. And then what is 210.23 times 0.6? 126.14.
4.
And what does that sum up to be? 226.89. Is that right?
I got 224.
224 and 2 cents.
Yep.
Thank you. Got it, okay. Whew. Okay, what scenario do we use?
The middle, second.
How many people want to use scenario 2? Raise your hand. Okay, I got 2. How many want to use scenario 1? How many want to use scenario 3? Okay, it looks like scenario 3.
How do you think which one to use?
What would be the rationale? We know that DCF is the most important. We know that we know that multiple is the second most important. We know that Gordon growth is the third most important, and perpetuity is the least important. So that kind of gives you a guide on what the weighting scheme should be. So which one? I got more votes for S3. Okay, so we'll use S3. Okay, and it's going to be the 224.04. Got it. Okay. So let's see. The intrinsic value equals what? 224.04. And what's the current stock price? What's the current stock price?
200.
It's 200. 200. 00. Current stock price. Got it. And is the intrinsic value greater than or less than or equal to the current stock price? It's greater. Got it.
We're going to buy calls, right? So it's
Yeah, we'll do that in a second. You got it. You're on it. So then, what's the premium? What's the premium which the intrinsic value over the current stock price? What's the premium?
$24.04.
We know that, but in a percentage. What's the premium? How much? Just this minus this divided by that is going to give me a percentage. Or this divided by that minus 1 times 100 will give you a, what is it? 0.02. Is that fairly reasonable? If it was 200%, would you think that our equations are off? But does a 12% premium over the current stock price, is that reasonable? Yeah. Got it. So what would be my recommendation? be the recommendation?
By calls.
Okay, hold on. First things first, patience. And if this was a really large REIT, this was a really large company, could we, and the REIT made up a significant portion of the REIT indexes, could we use REIT index derivatives to trade off of this valuation? So on the indexes, what would be our derivative trades? What would be our derivative trades?
By calls.
We would
By
buy what?
futures,
Buy what?
by futures,
Okay, we would buy futures.
by calls,
Buy calls,
by options,
futures. Okay, what else?
by options,
No, but we're missing something here. Go back to your exam. Go back to your exam, go to your memo. I would buy forwards. Okay, what else? I would write puts on the futures. And how many trades do I have? And if the REIT made up a significant portion of the exchange traded funds, could I trade those too? And what would be my trades? Could I buy the exchange traded funds? What did you say? You could also do what? You could also buy a margin. What else can I do? I can always buy calls. And I can write puts. And how many trades do I have? And can I buy, this was a, let's say an office REIT. Do you think that the office REIT that we just did, do you think that their share price is correlated to other office REITs?
yeah.
Yeah, because they're in the same sector. So what would be your recommendation? Buy. On margin. What else? Buy calls. And how many trades do we have? And how many total? Basically, we have 12 recommendations that we can bring our clients to trade, to take advantage of our securities analysis that we did, our REIT securities analysis that we did. Okay? So that's it. That's that one. All right? Okay, do you want to take a picture of that? Do you want to take a picture of this other side too? I'll give you a few minutes if you want to take the pictures. We'll have an eraser. There's some on the other side.
Professor, what's the difference between a forward and a future?
The forward contracts are over-the-counter custom contracts between two counterparties. There's no exchange, and they're custom. Futures contracts are standardized contracts that are made available and traded on an exchange, like the Chicago Mercantile Exchange or the Chicago Board of Trade or NYMEX out of New York or the London,
So would that mean there's a lower standard for forwards than futures?
You need to be an institutional investor to trade in this market, and pretty much anybody can trade these, and any individual investor could do those too. But this is a special product for institutional investors. Okay?
But there's still a premium you pay when you buy a forward, right?
When you buy the forward, you do have to pay a commission. But these things only settle at the end of the period. These settle every day based on futures prices. Okay. All right, and these are derivatives. Okay. Anybody else? Did you guys get that? All right, let's go to the next one. What's the next one? Commercial real estate development. As we know, there are 4 valuation methods. We should be able to do this one pretty quickly, right? Since we already been through a bunch of these. For this case study, we are going to use net operating income for the target development. The following are the case study. So we have perpetuity, vertical growth, we have the multiple approach, and we're going to use gross potential rental income. Discounted cash flows. In this case study, this is a high-rise office tower in downtown San Francisco, 52 stories and 1 million square feet. Does that sound familiar? Got yeah. I modeled this after Salesforce. Sales first half, which was financed by Boston Properties, which is a major office REIT. Basically built and financed it. And then Salesforce was the major tenant for that building, anchor tenant, where they had the transit terminal and retail on the bottom. Probably one of the biggest office developments on the West Coast. Probably the biggest mixed-use office development on the West Coast. Next to LA Live down in downtown LA are the Embarcadero centers in San Francisco. The 4 Embarcaderos, 750,000 square feet each, with retail on 2 floors on the bottom, and then the office towers. That was a big project. That was delivered in the early to mid 1970s. And then, LA Live came online probably, I don't know, maybe 10 years ago. That probably took about 10 years. I think that was about a $4 million project.
I kind of out of the topic. Since you're talking about the Salesforce building, the building next to it, it's kind of like the foundation from it's missing the height.
Yeah, it's a Millennium Tower.
Does that affect the Salesforce tower?
If it falls on it, yeah.
Even if they do repair on it before it falls on it, does it still affect the pricing on it?
It could. They already found a couple cracks in the support beams for the park. So the question is, part of the sinking to Millennium Tower, has it compromised the structural integrity of Salesforce Tower? That's a question. I'm not an engineer. Our engineers aren't doing that. So I don't know. But it could affect it. Millennium Tower was not anchored to the bedrock using the foundation work was not anchored to bedrock. So they basically used 40 floating concrete pads to sit on the mud, basically, without putting the pilings into the bedrock to anchor the building. So for some reason, the city decided to approve a project that didn't have the foundation anchored to the bedrock, and now the building is tilted and sunk 16 inches. Yep. And their Salesforce built with Boston Properties, the building right across the street from Millennium Tower, kitty corner, Salesforce building, and then Salesforce bought 55 Fremont, which was built in the early 1980s, right on the other side. So the Salesforce complex.
They like
Yeah, they have 3 buildings right there.
And
Salesforce,
Transit center.
they got 55 Fremont, and then they got the one right across the street. Yes. Yeah. So there's a lot of activity right there in that location. A lot of stress and pressure. So it basically proves that you cannot Manhattanize Yerba Buena code, which is where those buildings are located. If you go back 400 or 500 years, that was all swampland. That was mud flats. So basically, after the earthquake, they filled in Yerba Buena code, filled it in, and then started building the central business district, basically in a mud flat, okay, with subterranean creeks and they're very unstable soil in that area. And Millennial Tower is obviously an example of bad planning and maybe really bad engineering, if it can even be fixed. So that's what this one was based on. So let's go through the economics. So what's the first model that we're going to use to value this high-rise office tower in downtown San Francisco, 52 stories and 1 million square feet? So we're going to use the perpetuity. And what's the cash flow we're going to use? What are we using? What cash flow are we using? Net operating income. We're using net operating income. And do we need last year, this year's, and next year's cash flow? Next year's. So if we have this year's, can we get next year's?
Yes.
Yep. And what's this year's cash flow?
75 million.
75 million. And what is the growth rate in NOI for the first year?
12%.
Times 1.12. And that's going to give us what?
That is,
What's 75 times 1.1?
84.
What is it?
84.
84 million?
Yeah, I'm staying.
Got it. All right. And then what do we do with that? What's our expected return?
11%.
11%. 0.11. And what's the value using the perpetuity model?
Come on, guys.
What is it? It's 84 divided by 0.11. 763 million.
36. Oh, okay. 763.6 million.
4. Let's just round it. Make it easy on us. Okay, got it. What's the next method? Got it. And what do we use?
We're going to use the same 84 million.
We're still going to use the 84 million. Divided by what? 0.11 minus. Do they give us an NOI growth rate? Going in?
0.05.
0.05. That gives us what? 6. And what's the value?
1.4 billion.
1.4 billion. I'll take it. Okay. Does that sound about right? Do you think it cost about $1 billion to build Salesforce Tower?
Yeah.
So I'm just going to check it. What's the third method?
Multiple approach. Come on.
This one's a little bit different, right? Because we're not using NOI on this one. We're using the gross potential rental income. We're using the gross income multiplier on this one. So how do we get the gross potential rental income? Does it give us anything?
Gives us 100 million per year.
Yeah, exactly. So we got a 1 million square feet,
$100.
right, at $100 a square foot. And that gives us, what gross potential rental income? 100 million. Got it. Okay. And then do they give us any multiples? So this is going to be what? Value, price, divided by gross potential rental income. Do they give us any multiples?
20.
They give us, what, 24 times, 22 times, and 20 times. So that's pretty straightforward, isn't it? So it's 100 million times 24. Is that right? 2.4 billion? Is that right? 2,400 million? This one's going to give us 2.2 billion. This one's going to give us 2 billion. A little bit higher, significantly higher than these. Looks like people have been willing to pay it. Do people pay high prices for office buildings in downtown San Francisco that have been newly built? Yeah, totally. In that location and state of the art with a credited tenant like Salesforce. And I know everybody now wants to be, they don't want to be at 555 Cal or 345 Cal. They don't want to be, 101 Cal. They want to be at Salesforce Tower because it's the state of the art. So all these high profile tenants, really high rated credited tenants, want to be in Salesforce Tower. They don't want to be in the other product anymore. And they're willing to pay. Okay. And these are comparables. We found 3 comps over the last year of deals that have gone down on new buildings, maybe not in the same location, but these were some of the multiples that we found that investors were willing to pay for this type of building. Okay. What's the next method? Discounted cash flow, DCF. And what's the first thing I need to know?
Their operating income.
No, I want to set up the structure. Yeah, how many years? And what are we using? What we usually do is we use a 10-year pro forma period when we underwrite these kind of deals. We would use a 10-year, but for expediency, I decided to use a 5-year. Okay, because I don't want to be sitting there doing 10 years of calculations. So 5 years. 1, 2, 3, 4. What are we going to calculate the 6-year cash flow for? Got it. Do you want to do the cash flows first, or do you want to do the discount factors first? I would stick to the same methodology. And what is our expected return?
11%.
11%. And what is 1.11 with 1?
1.11.
What's 1.11 squared? 1.11 squared? 1.23. It's 1.11 cubed. 1.36. What's 1.11 to the 4? What? Got it. What's 1.11 to the 4?
1.2.
1.52, and 1.11 in the fifth,
1.69.
1.69, got it. So I'm just saying that. And what do we use, what cash flow do we use for the first year?
It's, 84 million.
You have the 84 million. And how do I get year two? How do I get year two? How do I get year two? 10. 1.1, so what's 84 million times 1.1?
92.40 million.
Wait, why are you using 10% again? Why is that?
That's the growth rate for the second year in the pro forma cash flows.
Oh, you're right. You.
Okay, and how do I get year three? Thank you. What's 9240 times 1.08?
99.79.
99.79. And how do I get year four? That's 6. And what's 99.79 times 1.06? 105.78. And why do you get year 5? 1.04. What's 105.78 times 1.04? What is it?
110.01.
Okay. And then we're going to need year 6, so how do we do that? How do I get year 6? What's 110.08 times 1.02?
112.21.
112.21 million. Is that right? Okay, now what do we do?
Add the total value to your fund.
Okay, how do we calculate the terminal value?
Divided.
Yeah, what do we divide that by?
You're going to divide that by 0.11.
By what? What do I divide the,
-0.02. Terminal.
what is it? What do I divide it by?
Terminal value minus the.
Yeah, what is it?
1.13.
0.13, because we're going to use the terminal discount rate.
Then you're going to subtract.
Subtract.
So it's 0.11.
Then what do we subtract it by? 0.02, and that gives us what? 1. And what is 112.21 million divided by 0.11?
1.02.
Well, let's do it in, keep it, don't do it in millions, do it in millions.
It's 1,000 million.
Is that right? Is that right?
Yes.
Got it. What do I do with the terminal value? What do I do with the terminal value?
Add it to the year 5. 110.
And what's 1,020 million plus 110 million? What is it? 1,130? And what do I do with 1,130 want to do with it? 1.69, and that gives us what? $668.64 million. And then 105.78 divided by 1.52. What does that give us? What does that give us? 69 point what? 59 million. Got it. And what's 99.79 divided by 1.37? $72.84. And then what's 92.4 divided by 1.23? Shh. I'm trying to focus.
75.
What is it?
75.12.
7512? Got it. Okay. And then what about this one?
75.
What is it?
75.
7568. Is that right? Okay, and then add them up, what do we get? What is it?
961 million.
960. 962. Is that good? 962. What do you want to use for the multiple? Which scenario do you use? Are we at the peak of the market? Do you think the market will continue to go up? Do you think rent growth will continue to go up 8 to 12% per year for the next 2-3 years? Downtown San Francisco with 4 million square feet coming online, with interest rates going up and the stock market basically down, 1,000 points this week and $1 trillion off the top in technology market cap. Are we at the peak? Have we peaked?
Yes.
Okay. We're gonna, after you peak, what happens? You go down. Okay. So do you think people are gonna pay 24 times? No. You're gonna pay 22? 20? But which one do you want to use? What? You want to be conservative? Okay. 2 billion. 1.4. 764. This is pretty close to this. This is pretty close to this. This is way out here. So how do you reconcile the numbers? How do you reconcile? What are you going to do? The investment committee is asking for you to come up with a intrinsic valuation, a point estimate. How do you do it? What do you want to do? We got to give them a number.
Give the employees kind of cash flow higher weight.
You want to do it on a weighted basis? I'm asking you. You have to decide. You want to do it like we did over here? On a weighted basis. So how much weight do you want to give the DCF? You want to, how much? 50? 50. 50? 25? How much do you want to give the multiple?
That one's like 5.
Yeah, but these are the actual deals that have gone down. These are actual deals. These are actual comps. This is what people are paying. Is that a theoretical model? Is that a theoretical model?
Yeah.
Are these actual deals that have gone down? Yeah, what their people paying. So what weight do you want to give the multiple approach? 25, 30, 25? How much do you want to give multiple? I mean, sorry, Gordon Road.
That could be like 15.
15? And how much do you want to give perpetuity, if anything? What?
10.
What is it? 10? Okay. So what's this? 76.4? Is that right?
I think it's 764.
764? Is it 76.4 or
It's 764.
is it 7.64 or is it 76.4?
763 by 0.6.
7.64, is that what you're telling me?
No,
That's 10%? No,
763.
Sorry.
0.63. So
I'm not gonna,
64, yeah.
yeah, it's fine. And then what's 15% of 1.4 million or 1,400 million? 210 million? You just round. Is that right?
Yeah.
And then what's 25% of 2 billion?
500,000.
How much?
500,000. Or 500 million.
500 million? Is that right? Okay. And then what's 50% of 962? 481. What's 481 plus 500 plus 210 plus 76.4? What is it? 1,267 million or 1.3 billion. That's good. Whew. That was awesome. That's a lot of work. All right. So let's do some of the mathematics. Let's make an investment decision. So let's do first the iteration. So what's the intrinsic value? Is 1,267 million. Got it. And what's the acquisition? What's the development cost?
It is 1.5 billion.
What is it?
1.5 billion.
1,500 million. And this is the development cost. And what's our net present value? What's our NPV? What's our net present value?
962 million.
What's our net present value?
No, that's present.
Next.
233 million. Is that right? You guys checking these numbers? Okay. Under this first iteration, would we accept or reject the project?
Yeah.
All right, but we really want to do this development. We really want to acquire this building. So what would be our second iteration?
That's for 233 million discount.
Yeah, we would ask for price reduction in the amount of the negative net present value of So if we were acquiring the building, when I put this case study together, Salesforce Tower wasn't done yet. So it was a development, not an acquisition. Same thing. So either if it was an acquisition of the current building that's fully occupied now, I would have to go back and get a price reduction in the amount of the negative net present value of $233 million. Or if it was a development, I would have to go back and reduce the cost of the development. The acquisition, the land costs, the development costs, the hard costs, the soft costs, negotiation with the city, the infrastructure costs, all that stuff I'd have to basically whittle down by $233 million. Okay? And if I can get a price reduction in the amount of the negative MPV, what's my net present value turn out to be? And when I accept or reject it?
Accept.
But I'm sorry, we can't get the price reduction and we can't get the development costs down. Okay? So what's our next iteration?
We do the cash flows? What is
Yeah,
it?
I would reevaluate the assumptions and I would go back and audit everything. I'd go back and audit. Go back and reevaluate the assumptions. And what are the assumptions? And I would go back and evaluate.
The growth rate.
Yeah, I look at the growth rates, which ones? Which growth rates?
Cash flows and expected rate.
I would look at the pro forma growth rates. Got it. What else? What other growth rates? What other growth rates would I look at?
Development costs.
What are the other growth rates? I'm going to stick to the growth rates.
Expected rate. Return.
Let's not do that yet. What are the growth rates?
Terminal growth rate.
Yeah, the terminal, and what else? What other growth rate?
Cash flow?
You already got this.
Especially with the return.
Not yet. There's one more cash. There's one more cash flow growth rate we're missing.
Going in.
The going in. Got it. Okay. And one other one. What other assumptions? They're all right there. If you audit the procedures, you can basically give me the assumptions that we need to go back and reevaluate. They're all here. They're all right here, and they're all right here.
We'll reevaluate how much rent we're gonna collect.
Oh, we already know that.
Is it the rate on the multiple approach?
Yeah, we probably have to go back and re-look at the multiples, right? See if they're right. Maybe some new deals came in at lower multiple or higher multiple. So we have the multiples. What else would we look at? What? Yeah, tell me more. What?
The first week we hire a lawyer for
This one? The initial cash flow? Yeah, because it determines everything, doesn't it? So first year cash flow, or the initial? Okay, what else?
Target development cost.
What?
The target development cost.
Yeah, you're right. I would go back and audit, under a development scenario, I would go back and audit the development. I would do that. What else? What else would I go back and re-underwrite? So here on the page, dude. It's not up here. It's on the
Expected
page.
return.
You gotta look at the page, man.
Expected
Look at the page,
rate of
man.
return.
It's on the page. You're up here. Is that up here or over here? It's up there, right on the page.
The expected rate of return?
Your expected rate of return, excellent. How many expected returns are there? How many expected returns? How many discount rates are there?
6.
6?
Oh, 5.
5? No, those are the discount factors. There's only one. There's two discount rates. What are we using?
11%,
Yeah, and that's the what?
that's the expected rate of return.
Is that the going in or the terminal? It's going in. Got it. And what's the other one? We've got the terminal. Got it.
I thought you had terminal, no, that's one you
No, that's for the growth rate. Any other factors in here we got to look at? There's another one in here too. There actually is another one. You got to look at the case study, man.
Do you have an extra one?
Oh, you don't have it?
I have it, but I left it home.
Oh, good.
Did we grow out the cash flows to more?
No, I wouldn't do the holding period. I wouldn't extend the holding period.
The gross potential rental.
Yeah, the gross potential rent is the million square feet going to change?
That was what I said earlier, you said no.
No, it's not. So what would
No,
change?
I said we could change the rent.
We could change the rents. Well, yeah, I'm not going to do it now, but I can do it now. Now I can go back. Maybe the rents went to 110 bucks a square foot. Okay, so I go back and look at the rents. Oh, did you say that before?
Yeah.
Oh, sorry, I didn't hear you. All right. Is there any others? Any others? Okay, so let's go through it. Let's go through it. So we got a negative net present value of 233 million. So you guys need to watch this. Okay? You guys need to watch this. Okay? This is important. You need to watch this. Okay? This is it. It's the most important part of the class. Did I over or underestimate the going in and the terminal growth rates? Over or underestimate? Are they too high or too low? Too high or too low?
Too low.
Too low. Too low. So I underestimated it. Right? So if I go back and I reevaluate the cash flow growth rates and I revise them up, what's going to happen to the present value? It's going to go up. Net present value. Up. Internal rate of return. Up. Payback period. Down. Got it? Okay. What about the pro forma growth rates? We already looked at these. We already looked at this one. What about these? Did we over or underestimate the pro forma growth rates? Underestimated it. Were they too high or too low?
Too low.
Too low. So if we go back, we find out that we underestimated and we revise them up, what happens to the present value? It goes up. Net present value? Up. Internal rate of return? Up. Break even? Down. Got it. Okay. What about the multiples? We go back, we reevaluate the deals that have been done. We find some new deals that have just gone down at higher multiples. So were we using too high or too low multiples? Too low. So if we can increase the multiples, find some new deals that traded at a higher multiple, what's going to happen to the present value? It's going to go up, the net present value. It's going to go up, the internal rate of return. Up. Break even. Down. Okay. We should all be going through this together. It's a sing-along. It's a Larry, real estate finance sing-along. You ever been to the Castro Theater and gone to the Sound of Music sing-along? Yeah, it's really fun. So it's like this. Okay, this is Larry's sing-along. So I want to hear you say it so that you burn this into your brain. What about the initial cash flow? Could we have underestimated the initial cash flow? Yeah. And what if we revised it upwards? what would happen to the present value?
Goes
Go
up.
up. What happens to net present value?
Goes
Goes
up.
up. The internal rate of return goes up. And the break even goes down. Excellent. All right. What if we audit the development costs? Do you think that we could have overestimated the development costs?
Yes.
Yeah. And if we could bring down the development costs, what would happen to the net present value? Internal rate of return and the break even down. What about the expected returns? Could we have overestimated
Underestimate.
the discount rates? We have overestimated the discount rates. If we're using too high of a discount rate, what's that going to do to the present value? Make it go down. If we go back and we say, hey, investors, are you willing to take a lower expected return, both on the terminal and the going in? If we can lower the discount rate or the expected return, what happens to the intrinsic value? Goes up. What happens to the net present value? Goes up. Internal rate of return goes up. Break even. Got it. Okay. What about if we find out, we do the rental survey, and we find out that actually rents have moved from 100 to 110 bucks per square foot, and we can start renting at a higher rental rate? What's that going to do to the net operating income? It's going to go up. And if we can revise the gross rental income and the net operating income up, what's going to happen to the intrinsic value? It's going to go up. Net present value, up. Internal rate of return, up. Break even, down. Okay. Got it. But I'm sorry to say, we went back and we audited everything, and we still get a negative net present value. We did a really good job of the underwriting. The market's actually started to turn a little. So our assumptions and all the research that we did was correct. Do we have another option?
Yes.
Yeah. We have one more iteration. What we can do.
Value of the real call.
Yep. We can value real call option. Okay. And do we know what the methodologies that we would use to calculate the value of the real call option?
Black-Scholes.
These Black-Scholes. Any other? What's the other method that we could use? What's the other method? There's two. What's the other method that we could use?
Oh, binomial tree.
Yeah, the binomial tree. Okay, these are the methods that you're going to be learning when you maybe take an investment course or you decide to get a master's degree with a concentration in finance. What are the three factors that drive the value of the real call options?
Time.
Yeah, time. There's time value. What's the other one? What's the other?
Volatility.
Yeah, the value, price, volatility. Okay. And what's the third?
Premium.
Yep, what's the third factor that drives the value of the real call options?
Value,
One more. Do you have the notes?
uh,
Do you have your notes? Do you take notes?
Well, management decision.
You got it. Management decisions. Do you think that there's a lot of management decisions in a $1.5 billion? Yeah. So they can wait, they can execute, they can do all kinds of value add, aspects of the development process through management decisions. So we go and we just give you an example. So this is your exercise price. This is the development costs. There's the premium. And these real call options don't trade. This is just a theoretical model that you use to augment your capital budgeting decision making. This is the premium. And as the value of the property goes up, you're going to reach some kind of break even. This is the value of the property. And where is Salesforce located? Where's the building located? Downtown San Francisco. So what do you think the majority of the tenants that occupy that building are? What sector are they in? Tech. Is tech volatile? Is tech a volatile industry? Yeah, it is. So if you have volatility in the industry that occupies the majority of your building, do you think that the value of the building is going to be highly volatile? Yes. Absolutely. And what you'll see is the value is going to go like this and this, and then all of a sudden, they could go through the roof. So this delta here, this is your profit. And if you make it into here, you're going to be in the money. In the money.
I like it.
In the money call option. And you can justify overpaying for a building. You can justify overpaying for a building if you understand and you can calculate a real call option value. Because the premium that you would pay is the negative net present value. So the negative net present value is the premium that you basically are paying for that real call option. Okay? So the question is what is the value of the real call option?
230.
What does the value need to be?
230 per million.
Minus the NPV, right? Minus the NPV. And if the value of the real call option is equal to the negative net present value, what's your net present value? If the value of the real call option is equal to the negative net present value, what's the value of the net present value? Zero. And would you accept or reject it? Accept it. Got it. And what if the value of the real call option is greater than the negative net present value? What's your net present value?
Greater than zero.
Yeah, it's what? Positive, zero, or negative?
Positive.
Positive. Got it. And would you accept or reject it? Accept it. And what if the value of the real call option is less than the negative net present value? What's your net present value?
Negative.
It's negative. And if it's negative, do you accept or reject it? Reject it. Got it. That's it. That's it. Whew. That was a lot of work. That's some heavy shit, dude. Huh? Yeah, I'm telling you. I'm taking you through the boot camp. Okay, what time is it?
Number of break.
Yeah, it's time for a break.